As we pivot forward, when we look at the consumer and some of the issues that we've seen, I thought this was a very interesting chart in terms of search trends, because typically, as we've seen through, the advent of Googling and as it's become a verb, you have the ability to kind of see what are people thinking, and before it actually goes into the actual data, because people will search for it, kind of educate themselves before they carry out their practice. So here, search trends as tracked by Google Trends underscore consumer stress, interest in SNAP, food banks, and unemployment benefits back above long-term average. So when you look at just, the movement of things that people do when they're under pressure is coming back to these extremes that we've seen in previous times, kind of pointing to that stress that we've been talking about. Now, the bigger issue that we've discussed in time and will come back into play when we talk about interest rates and mortgages, you still are only earning 25 basis points at the bank. So at this point, you're earning 25 basis points, but inflation is over 8%, and my mortgage rate is now, let's call it 6.5%. But if you go back to the 70s, when you had mortgage rates at 17, 18%, you had saving rates at 15%. So when you look at the delta between the two, it's much worse today than it was then. And that's something that has to correct itself, because no one is making money from their savings, and the ARP on their credit cards are going from 16% to 20%, and a lot of people are borrowing against them. So as you roll that debt, it just automatically rolls to the new rate. You're not locked in at that rate. So again, more pressure coming, and it's just a matter of when does the consumer make that pivot and that break, and we think it is obviously very close. Now, when the other indicator that it is U.S. retail inventories, and the U.S. retail inventories billion deflated by core goods CPI. So it's interesting because this is what we were talking about in terms of the value of the inventory. People spent and companies spent elevated pricing to ensure that they have it available. Now they're stuck with these inventories at these massively high prices just as prices come back down, and people are looking and slowing down their purchases, which is creating some of this bifurcation, but also shows that there is a lot of inventory in the market. There's a lot of pressure in the market, and that is creating some of the different pressure points that we continue to see. Now, when we start looking at the consumer, the Conference Board September Consumer Confidence Index up to 108 versus the estimate of 104.5. Present situation up from 145.3 to 145.4. Expectations up from 75.8 to 80.3. So again, you're still seeing some of that confidence it remains. Gasoline helps. Now gasoline prices are creeping back higher because of BP Toledo, and you're going to see some of those additional pressure points, which again it just shows that there's still more pressure to the downside. University of Michigan already much lower, but here's where we can see some of those additional movements down. Higher rates have helped U.S. corporate pension plans. For those that have been following me or talking to me for years, I've been talking about how pension funds had a conundrum, because they can either tell their constituents that, 2.5% growth no longer going to happen. You have to expect 1%, and then they can maintain their risk parameters. Instead, they got riskier. They started doing more emerging markets, more alternative investments. But now with rates coming back up, they're in a better position. And that was one of the benefits of kind of where prices are going. And again, it should be a benefit for people's savings accounts, because the bank is making more money. The bank can invest some of this and again, still collect a VIG and give you some of that upside. And those are some of the additional pieces that we've talked about, with higher rates helping U.S. corporate pension plans get to fully funded status. Funded ratio of 100 largest corporate pension plans increased to 106.4% in August, jumping further out of the sub 100% territory, which is the first time since the great financial crisis. So again, it's not a bad thing to see some of these rates normalize, because again, you can have a certain amount of risk-free comfort in some of these assets. Now, when we shift over to durable goods, August durable good orders came in at -2% versus the estimate of -3%. Then when you look at transportation, it came in at +2% versus the estimate of +2%. Trends still relatively strong at about 11.2. So again, and this feeds back to what we were talking about with the Fed data, the regional Fed data. You're not seeing a collapse, and that we've been talking about that on the manufacturing side. Is it's not just this huge drop down. People are getting kicked to the streets. They're slashing different pieces in terms of 3 out of one out of 3 of the crews is now gone. No, it's just they're cutting hours. They're trying to be precise because there's still a bit of a backlog on the manufacturing front, which we think gets much worse as we get into Q4, but really Q1 of 23, and this is going to remain some of that backstop. Now, August wholesale inventories came in at 1.3% versus the estimate of 0.4%, and this is the problem. Retail inventories in the orange were up 1.4% versus the estimate of 1%. So inventories are increasing, which is why we see that other durable side and all of the other pieces getting worse because inventories are building. We're seeing a lot of that backlog coming back. And that is, I think, the underlying pressure point that we've been talking about. And this inventory is why we see, again, that slowdown in trade, that slowdown in purchasing, and it's really showing the softness in the consumer. Now, the CPI nowcast from Cleveland Fed currently has inflation coming in at 0.3% month on month. Still growing. Again, still elevated, and that's why we still see exiting the year at a very elevated rate. And we haven't even started, we're starting to see stagflation, but we still have inflationary pressures, which is why inflation is not going away anytime soon, because it's just going to give way to stagflation and then some much bigger deflation, but that's going to be that 2023 event that we've been talking about. The spread between expectations and present situation component within consumer confidence has ticked up, but is still hovering in recessionary territory, which is what we've been talking about. Expectations are still much, much lower, which is where that disconnect is. But if you look at the University of Michigan and some other data, it's much closer, which is why we think that there is that movement to the downside. Now, when we look at core capital good orders have been outpacing core capital good shipments, reversing the recent downtrend, not yet back to peak spread seen during the pandemic. But again, you're starting to see some of these movements, and that's where we have to watch to see some of those trigger points that could get a bit worse. Now, as we shift into the real estate space, I thought this was a great chart that was created by Bloomberg and McDonough at Bloomberg. Mortgage rate. So it's when you look at it for a $2,500 a month payment and 20% down, you can afford $476,000 home, but in early 2021, you could afford a $759,000 home. And that is the scale down. That is the pressure that we've been talking about, where people can no longer afford to be at those levels. And that's why we see that consolidation in pricing and that pressure really starting to ramp back up. Home prices came in at negative 6.6% month on month versus the estimate of 0. So when you look at this is the largest monthly drop since March of 2011. And this was July. So again, we still have more pressure coming, showing what was happening in August, September, and now what we expect to happen through the rest of the year. Annual change in median new home price fell to plus 8% in August. Still strong, still strong, but weakest growth since November 2020. So again, you were already going 120 miles an hour, and now you're coming down, but you're still going fast, which is why there's still so much downside when we see the pressure points as we bleed into 2023. Higher mortgage rates weighing on housing markets. July release of the S&P Case-Shiller U.S. Home Price Index came in weaker than expected, with the index registering the first month-on-month drop since February of 2012. It's a shift in home price growth as it fell negative 0.44% month on month. First monthly decline since March 2012, and worse since November 2011. So you're seeing the comps in terms of where that pressure is going and how that is going to lead to future sales. Because you see it starts slow and then it accelerates, and it can last for an extended period of time. We've seen this happen and last for years, and that's something that we do see happening once again. In July, 86% of refinance deals required homeowners to pay higher interest rates, largest share on record. The rate increased by an average of 1.3%, also a record. So again, you're not going to refinance unless you have to take cash out. And this is just another example of how people are coming under more stress, and those equity lines that they have really won't be able to carry you. The drop in pending home sales continues at negative 22.5% year-on-year drop and is among the worst on record. So again, those pending home sales, there are no pending home sales. There is a bit of a seller strike, but it's just because no seller is now willing to take the haircut they have to take after seeing such elevated pricing for so long. Now, when you look at the home sales, so you had the big spike in home sales. So let's talk about this for a moment. August new home sales came in at 28.8% versus the estimate of negative 2.2%, and then the prior month of negative 8.6%. Median new home prices increased 8% to 436,800. Average selling price at $521,800. Monthly supply fell from 10.4% to 8.1%. But let's consider how it's calculated, because again, this is where statistics gets fun in terms of the calculation. The calculation terms balance out, but you have to look at how the Census Bureau numbers and what they do. So sales net equals sales gross, which is how it should work in the long term. But in the short run, when cancellations increase, the Census Bureau overestimates sales. And when cancellations decrease, they underestimate sales. So there's essentially a fixed number of what is the average number of cancellations. And they use that to carry through what is happening. Now, what we know from the mortgage data, from the rates data, is that cancellations have spiked because they either no longer qualify, they were rejected by the bank, or they can just no longer afford what the actual rate they got. So that cancellation doesn't get picked up yet, which just means that we're going to get a big write down, and it'll normalize. But again, this resulted in this big shift higher, which will come back down. Pending home sales continued to deteriorate, came in at negative 2% in August versus negative 1.5%. Midwest led declines at negative 5.2%. So again, the pending home sales, the mortgage data is showing the problem, so that home sales one will see that shift down. Active listings of homes for sale, the 0% year on year. Again, you're starting to see that rollover. And then when you look at housing growth for the prime home buyer population, that's where you want to look at where is some of that capacity? Where is that capacity coming online? And we have a chart further down to show where those listings are. But when you look at active listings of homes for sale, you're seeing that slowdown. Again, that is that seller strike that's like, I'm not selling at this price. Like, I would have sold at the price 6 months ago, but not at this price. And that's where you're starting to see some of that slowdown in general. But home appreciation is really starting to become the bigger concern. And this just looks at it in general on that sliding scale in terms of, okay, well, where's the mortgage in terms of fixed rates? And then what is the average cumulative purchase loan size? So as you can see, 2022, you're looking at the biggest increase since 2000. And that is the biggest problem, because in 2000, you had average fixed rates at 7.75%. Excuse me, but you had home prices so low. So now you're going to have to see some of that adjust. And just given what the Fed is doing, what central banks are doing, it's not going to be because rates are coming back down. So then when you look at home purchase mortgage applications for home purchases are down 29% from a year ago, off 43% from their seasonally adjusted peak in early 2021. And again, those are some of the key pieces that we've been talking about that shows that actual sales number is much lower. And this is my favorite chart, looking at the home price index versus the hourly earnings. One of those has to adjust. And do you push wages higher, creating a wage spiral, or do you create a housing crisis? And because when you look at from 2020 to now, they created a housing crisis. Now, on the other side, so the unwind has to happen, which is, again, why the Fed is not going to stop. They need those numbers to come back down. Now, when you look at volumes, completed homes for sale and months to sell, number of months for sale since completion, number of completions, starting to come back up. But new home inventories, you're seeing the new home inventories coming back up because the under construction remains so elevated, and that's the missing link when people talk about we're short volume, we're short No, it's under construction. It's coming to market, and the question is going to be what price can they get? And as that new volume comes on, we'll see those prices continue to move lower. And that's when you look at pending and existing home sales. Again, that moving down with the ratio of existing home prices to median household incomes is showing how unaffordable the market is, which is where we see that adjustment. So that's what we have for you for the remainder of the US. In the next segment, we're going to go deeper into Europe and the UK. And those are things that I think are very relevant for kind of where the market is and how it's trending over the next few months.